Hi, my name's Amanda Sanchez. I work closely with HOA management companies, primarily at the executive and ownership level, helping identify areas where revenue quietly leaks and where capital can be recovered, retained, and redeployed more strategically. There are many areas where revenue leakage happens, but I want to start with one that most management companies don't even consider: research and development tax credits. And there are two important reasons I want to start here. Firstly, the window to file for retroactive dollar-for-dollar tax credits is closing. That window expires in July. And secondly, when these credits are evaluated properly, recoveries can be substantial. I'm talking 6, sometimes even 7 figures, especially when you look back across multiple years. If your management company has been growing, adapting, or modernizing operations, you could very likely qualify. So rather than talk broadly about optimization or best practices, I want to start with a lever that can create real financial impact now and materially change how a company invests and plans going forward. When most people hear R&D, they think labs, engineers, or software companies. That assumption alone causes most HOA management companies to self-disqualify. But R&D credits are not just about invention. They're about how organizations solve operational uncertainty. If your company figures out how to do work when there isn't a clean, off-the-shelf solution, you're already in R&D territory. This is not a loan, not a grant. It's a long-standing, well-established federal credit. HOA management companies are actually uniquely positioned for R&D credits, often more so than industries that assume they qualify. As you know, every portfolio is different. Every board of directors is different. Every community brings its own governing documents, compliance challenges, financial quirks and expectations. In practice, R&D often looks like things you're already doing, like fixing onboarding when records are incomplete, customizing accounting workflows for different associations, adapting systems when statutes change, reworking AR or collections when the default process breaks down, or modifying software when it doesn't actually work the way it's intended. Even adding new landscaping to the front of your office building can qualify. All these kinds of work involve trial, iteration, and refinement, not just execution. That distinction is exactly where R&D lives. So what does this credit actually do for a management company? Plainly said, it reduces your tax liability dollar for dollar. In some cases, the retroactive credits can generate refunds in the 6 to 7 figure range and overall improved cash flow without increasing revenue pressure. That capital can be used to stabilize margins, invest in systems, better support your teams, or simply create some breathing room in an industry where pressure continues to rise. If you've already been told you don't qualify, that doesn't automatically mean you don't. R&D credits aren't evaluated through a standard tax checklist. They require operational interviews, documentation, and a specialty approach. My role is not to replace your CPA or sell tax products. I help management companies determine whether this lever exists for them, translate operational reality into the right framework, and connect them with the very best specialist to handle the application. And sometimes the answer is no, and that clarity still matters. If you run an HOA management company and want to understand whether R&D credits apply for you and what may be at stake before that retroactive window closes, feel free to reach out. At minimum, you'll gain clarity, and clarity is always a win. Thanks for taking the time to watch. I'll share more as we go.